Hello, folks. Welcome to Pro Trader Strategies Market Commentary. We are an educational company, so if you want to learn about how to trade the markets and or what options are and how we can implement those based on those assumptions we come up with market analysis, hit that subscribe button so that you guys can get notifications when we're doing these videos. Also, every Thursday, I do webinars on a specific option strategy. And what we do is we look at that underlying and find the best option strategy for that given assumption. So I show you how to do that really quickly and easily in these videos. So please check those out at protraderstrategies.com. Finally, comment, or actually not finally, but comment over there on the side throughout this video. If you have any questions, comments, or you want me to cover something, I'd be happy to do that during these. So keep me on my toes. And finally, smash that like button for us. It really does help us out. Finally, hey, my name's Eric Wilkinson. You guys might recognize me from mainstream media, but I talk about the economic data, the geopolitical environment, how that impacts the markets with my market analysis there. Well, I do the same thing in these daily market commentaries. So let's get on with the economic data. Across the pond, really not a whole lot going on, but here in the United States, we got our PCE, which is personal consumption expenditures. Now, you've heard me talk a lot lately about PPI, which is producer price index. That's what the producer pays, right? And then the CPI is this consumer price index. That's the entirety of the consumer. Now, personal consumption expenditures narrows that down even further to like the retailer, the person that's out there spending every single day, not necessarily a corporation or anything like that. So this is what is affecting you and I and how it is affecting you and I. So the personal consumption expenditures core index, which is going to strip out food and energy because it's a little bit more volatile, came in at 0.5%, expected to be 0.6%. And remember last month it came in at 0.7%. So we're seeing that come off a little bit, which is, you know, on first blush, a pretty good reading, right? We're seeing these prices come down that you and I have to pay for outside of food and energy. But know that these numbers are as high as we have seen since the 90s. Okay, usually this number is basically around 0.1 or 0.2. So a 0.5 is pretty dramatic, folks. All right, and personal spending coming in at unchanged, expected to be 0.4%, and personal income a little bit better than what was expected, only -2, expected to be a -2.2. So that number better than expected, but still personal income at a -2% is pretty large. Usually that is a decimal type number, all right? But since the pandemic, all of that has been kind of thrown out the window, as you know. University of Michigan consumer sentiment comes in at 85.5. That is a little bit lower than what we were seeing in the past. We were seeing that number like up in the hundreds during 2020 and before. 2021, we've really seen that number come off quite a bit from those hundreds, now in the 80s. And then finally, inflation expectations at 4.2%, which was pretty close to in line with what we were looking for. A little bit hotter than expected there, but pretty close to being in line as far as I'm concerned. All right, let's get on with the overall markets. And believe it or not, I remember to share my screen on the first try. So we're getting better at this, folks. Also, all right, let's get on with crude oil. Crude oil, we saw these inventories coming off a little bit here. That is going to be due to supply constraints that we're seeing here in the United States. Remember, we're not fracking nearly as much as we were. We were at a point where we were producing about 11 million barrels a day. We're a little bit below that now. So we're seeing some of these supplies come off a little bit. That's giving crude oil a bit of an open door to run towards around $80 is what it's looking like, especially even with the demand that we're seeing coming into the system here. All right, gold futures, bonds. Bonds coming off today. You know, the whole thing with bonds is I think they're going to stick right around here at a 150, 160 handle. 160 handle really the sweet spot. As the Fed has been giving both sides of the coin, but for the most part, what we're looking at is the Fed is not going to have any real action until 2022, and that's going to come in November where they start maybe limiting some of these asset purchases in the bonds. But that's still a ways off, so I think bonds are still going to stay relatively elevated here. Bitcoin is coming off as everybody is talking about the cryptocurrencies. Tether, Dogecoin, Bitcoin. I guess the big thing right now is that Elon Musk and Jack Dorsey are going to chat about it sometime in July at some seminar they're going to be doing. That people were hoping that was going to give a little bit of a boost to Bitcoin, but it seems to be the catalyst to sell it off a little bit today. All right, gold futures moving a little bit higher today. We're seeing gold really struggle with the strength of the dollar. And on the flip side of that, we have inflation worries. We're seeing inflation ramp up. We should see gold start to move. But it looks like right now that this strength in the dollar is really the catalyst that's driving gold off. Now, VIX is coming off today. Folks, today it feels like one of those days. It's a summer Friday. All right. And when we were on the floor, we used to say summers on Fridays in the summers was a rush to the Hamptons. Basically, starting at around this time, 11:30 to 12:30, we would start to see volumes really start to suck dry and orders canceling. So that becomes the retail trade. The retail trader, as the institutional investor, is on the sidelines, maybe in the Hamptons or something, is what we used to assume. It was a rush to the Hamptons or just to get away for the weekend. Now it could be more volatile, and that gets a little bit dicey. So Fridays, late afternoon in the summer, I always have a little bit of trepidation. You know, sometimes you want to try to do too many things on a Friday. If you were down heading into a Friday, you're trying to make it up. If you are up Friday, you're trying to do everything you can not to give it away, and you're not making the best mechanical decisions going forward. So make sure when you're trading, you can stay mechanical with all of these things. And days like today has a tendency to get even the best traders to do some silly things. And I don't want to see you guys fall into that trap. Okay. We've got the Dow Jones leading the charge to the upside. It's been the real lagger as we've seen the E-mini S&Ps, the NASDAQ making new all-time highs. The Dow Jones Industrial Average has been the lagger. Yesterday, we did get above that 50-day simple moving average, kind of clearing the way to the upside. You've heard me talk about this time and time again. Above and below that 50-day simple moving average is a real good sentiment of bullishness or bearishness in the market. And when you get below it, it's pretty bearish. You get above that, you start seeing the strength come back into it. And yesterday, we saw the market come in full force. And then today, we're getting that follow through. So some strength here in the Dow Jones Industrial Average. E-mini S&Ps up on the day, as you can see. NASDAQ, obviously, the one that was in negative territory. It is the lagger. And overnight inventory was pretty flat coming into today. We had Nike earnings knocking it out of the park. Good forward guidance. Those guys, I'll pull up a Nike chart here in a minute. That's really driving a lot of the broader markets, and especially some of the retailers, even Lulu and some of those other ones are looking to have some follow through there. FedEx getting crushed. I think there's an opportunity there in FedEx. So eBay, let me just talk about my trade in eBay real quick, and then I'll get on to these other two. But in eBay, I dumped out of this. You can see the directional move yesterday got me out of this. Now, I want to break this trade down just a little bit. If you guys remember, it was on the 14th of last month, or 14th of this month, I'm sorry. So right here on the confirmation we got on the 14th. That was a Monday. Market slid off. Directional move did very well. I did this trade with high implied volatility. I didn't know necessarily which direction this volatility was going to go up or go down. With a directional move to the downside, I would worry that volatility would start jacking up a little bit. So I've got a bearish directional assumption. I just wanted to completely negate the theta decay and the volatility fluctuations in this. And by doing that, I created a synthetic short. So rather than going out there and borrowing the stock and doing all of those things, paying maintenance, it's just a huge headache to short an underlying. But with options, you can use less margin. It costs, the transaction cost is much less. And finally, it performs just like the underlying. So why not? Well, I'm not getting, I don't have to pay the dividend. And if you do a synthetic long, you don't get a dividend, but you don't have to pay the dividend also with synthetic shorts, whereas with the real short, you do. All right, so anyway, I built this out as a synthetic short. I bought the October 65 puts and then sold the 65 calls to create that synthetic short. What that does is I create a trade where I have 100 negative deltas. The 65 calls were the 65 calls were about a 50 delta. So when I sell those, that becomes negative 50 deltas, right? And then I buy the puts, which is a negative already 50 delta put. So if I buy the 50 negative deltas and sell the positive deltas, that becomes negative. You add those together, that makes a total of 100 negative deltas. So for every dollar the underlying moves down, I profit $1. And every dollar it moves against me higher, then I lose $1, all right? So I got involved in good strike location. Yesterday, I was hoping for a bit of a correction to the downside. I was hoping that we would get this market to confirm again. So a little bit of a bounce, that's normal for a synthetic short. You're going to get bounces. I'm not going to get the exact move straight to the point of control off of one move. You usually see slow bounces throughout that, just like any given market. That's what I was hoping for yesterday, but as soon as we started breaking above the previous day's wick, which is what I talked about yesterday in the daily market, yesterday in the webinar, we break above that. That's when we pull the ripcord on it. The structure of our setup has broken. There's no confirmation. I got it. I usually get in a little bit early, and on this one, I actually waited for the confirmation, but it had that bounce, which I was kind of expecting. I didn't get too panicked about it. But yesterday, when the market breaks above the wick, it's not looking to come back. So I ended up covering it close to the end of the day there on this trade. And so with that said, I ended up buying back the synthetic short for $1.78. Sorry, I paid $1.78 for that. So I ended up losing over $1.20 on it to the move to the upside. So really, when you're building these out, because I did it for a credit, I got short this underlying at 65.50, and by buying it back for for $1.80, let's say, that means I got out at 66.80 on this trade. So when it broke above the previous day's high, that's when I decided to pull out of that one. All right, so let's take a look at what I didn't do a trade for Nike. Kind of slipped my mind, to be quite honest, but they talked about the constraints on producing the shoes. They said that the brand recognition is through the roof right now, and all of their things, forward guidance was just really good. I think they beat by like 40 cents. 51. It came out 93, so beat by over 40 cents and up almost 15% earlier today. So Nike knocking it out of the park. FedEx, though, I think is an opportunity today, or maybe even Monday. Wait till it kind of shakes out today. But I think that there's an opportunity in FedEx for the upside. I don't really see people slowing down on their Amazon purchases and things of that nature now that we have opened up. Yes, I do believe more and more people will go to the malls or the brick and mortar places, but I do think that there is a huge sector of the economy that is switching over to like Amazon because of this pandemic. They've actually found that very easy and convenient. All right, and that's about it for you folks. All right, don't forget to hit that subscribe button so that you guys get notifications when we're doing these webinars where I drill down on the structure of a synthetic short, how to set that up, what we're looking for in these swing type trades. So check those out. All of that stuff is being done right now. We're going through this course, so you can participate in those live if you want. So like I said, I want to make sure everybody's clear on concept, going through the questions, comments, everything else. All right, so please check that out. Comment, subscribe, all of that stuff. And finally, if you can't smash that, hit that. Bye for now. Take it easy.